So today we're going to talk about ethical ETFs and how you can get started with ethical investing. Now, as you guys might know, the world is changing quite quick, and oftentimes companies in search of profits may end up choosing the easier option, which might end up hurting the environment. Now, as investors, we have a choice whether or not we want to invest in companies like that, or if we're going to invest in companies that are making the right investments and they are moving towards sustainability. It's really our choice. And even though all of us are retail investors, our individual impact might not be a lot in the grand scheme of things, but at least we can invest in stuff that aligns with our values. And this trend of ethical investing is fast growing, as you guys can see, so collectively people can make a change. Well, that was a bit of a long intro, but hey guys, my name is Fyzee and this channel is about finance and investing. Before we begin, this video is not financial advice. I'm not a financial advisor. We are speaking in a very general sense only. Please do some research about these ETFs as well. So let's get into the first ETF, which is ASX ETHI. So ETHI is the BetaShares Global Sustainability Leaders ETF. So to put it simply, this ETF invests in a basket of global companies excluding Australia. And these companies are climate leaders, and the ETF exclude companies who are directly or indirectly related to things like fossil fuels, tobacco, gambling, animal cruelty, even junk foods as well, or if these companies make investments into areas that are non-sustainable. And of course, this ETF follows the ESG criteria, which stands for environmental, social, and governance. Now, looking a bit closely at this ETF, you guys can see that ETHI is at the core of this chart. The companies must meet market cap and liquidity requirements, and they must be from developed countries. And then climate leaders are selected from the top 1/3 of the performers in terms of carbon efficiency in their industries. And these companies also need to have gender diversity, no gambling, and other criteria as well, as you guys can see. Now, looking at some key facts for this ETF, the management fees are 0.59% and the distribution frequency is semi-annually, which means that you will get a dividend twice a year. Now, these fees of 0.59% may seem a bit high. However, in just a second, we're going to look at the fund's returns so you can see why it might be worth paying this fee. Looking at some of the holdings for this ETF, you've got the big names like Apple, Nvidia, Tesla, and a few other companies as well. But we are missing some other huge companies as well, like Microsoft, Amazon, and other companies too. Because for the requirements that we spoke about earlier, those companies don't meet the ETF's requirements, therefore they are excluded. And having a look at the sector allocation, we can see that most of it relates to largely technology, but then you've got consumer and financials, which are roughly less than half of technology. And the country allocation for this ETF seems to be mostly towards the US, but then you've got Japan and a few other Western European countries as well. Now let's have a look at the returns for this ETF, and we can see that the 1-year return sits somewhere at around 13.77%. But if we look at the return for the last 4 and a bit years, we can see that the return has been around 96%, which is actually pretty strong. So roughly you would have doubled your money if you invested in this ETF around that 2017 time, which is fairly solid. But of course, past performance does not guarantee in any way, shape or form the future performance. And let's have a look at the second ETF on this list, which is ASX FAIR. Now, this is the Australian Sustainability Leaders ETF, and a simple way to look at FAIR is that it's kind of like ETHI, but the Australian version of ETHI. So this ETF basically follows a similar criteria to the one that we just had a look at. So as you guys can see, FAIR has a 4-step process right here in this graph. So the first part of the process is to make sure that they are listed on the ASX and they meet the market cap and the liquidity requirement. The companies which use fossil fuel are removed from this ETF, and then the broad exclusions are applied to remove gambling, tobacco, animal cruelty, and other similar things. And then after all of those measures and all those screenings, you get a bunch of companies that are left. And then from those companies, the top firms are selected, which are leading the way when it comes to sustainability, like renewable energy, water efficiency, and things like that. And looking at some key facts for this ETF, the fees are around 0.49% per year, so they're a bit better than the last ETF that we had a look at. And the distribution frequency is semi-annually, so once again you get a dividend paid to you twice a year. The portfolio holdings include companies like Telstra, Xero, Goodman, Cochlear, and a few other companies as well. And the top companies roughly have a weighting of around high 3s to around 4%. Now, usually with the normal ASX 200 ETF, we usually see the top companies being the miners and the banks, but here you can see that the top 10 holdings basically include no financials and no mining companies. Almost anyways. Now, having a look at the sector allocation for this ETF, this is where things get pretty interesting because we have healthcare at about 25%, Then we have real estate at 19%. If you compare this to the overall ASX 200 index, the top two sectors are financial financials and materials, but here we can see that materials takes up a significantly less portion of this ETF's allocations, and financials is no longer the top component. It is only around 16.8%, which is quite a lesser weighting. And having a look at the returns for this ETF, since inception, it's been returning around 9.61% per annum, which is pretty strong. Next up on the list, we have a Vanguard ETF. This is ASX VESG. This is a Vanguard Ethically Conscious International Shares Index ETF. Now, having a look at some quick facts for this ETF, we can see that the fund size is roughly around 260 million. It's domiciled in Australia, which means that when it comes to tax time, you're going to have less issues when it comes to doing your taxes because you won't have to fill out a US tax form, which is pretty good. And the fund inception is only pretty recent at September 2018, so we don't have too much history for this ETF. But if you guys have a look at the management fees, this is super low at 0.18% per year, and this is pretty much in true Vanguard fashion because out of all the ETFs on this list, Vanguard has the lowest fees, and as retail investors, this is what we usually kind of expect from Vanguard anyways, and fees of 0.18% per year means that you'll be paying around $18 per $10,000 invested. So what exactly is the aim of this ETF? So this ETF tries to give you exposure to the largest companies in the entire world in developed countries, and of course, as usual, they try to exclude companies that are involved in sectors like mining, fossil fuels, and even adult entertainment. So again, as you guys can see, this ETF is pretty similar to the first ETF that we had a look at, which was ETHI. However, a major difference between ETHI and the Vanguard ETF is the fact that you can see that this ETF holds nearly 1,600 companies, which is pretty huge, and ETHI doesn't hold nearly as much at all. In fact, ETHI only has around 200 companies in their fund, which means that you're getting access to quite a lot of companies with Vanguard. Having a look at the sector allocation for this ETF, 1/4 of the ETF is still technology, and then you have consumer and financials. So it's fairly similar to the first ETF that we had a look at. And then having a look at the market allocation, this is again pretty similar to the first ETF because you have the United States at the top, then you have Japan, and then a few European countries as well. However, looking at the holdings for this ETF, you guys can see that they have included Microsoft, Amazon, and Google as well, and this is what we were missing in the first ETF. So here are the few key differences between those two ETFs, and this could be because these two companies do have two different fund managers, and based on those different screening processes, they might be using different metrics, which is why they have different companies. So having a look at the returns for this ETF, once again, we don't have too much data, so the returns are going to be a bit skewed. So as you guys can see, the return for 2020 was around 10%, and then the return for 2019 was around 30%, which is of course not too accurate, and we can't really expect this type of return to continue forwards. Now guys, if you are finding value so far, please leave a like and subscribe. It really does help out with the YouTube algorithm. Thanks guys. Next up on the list, we have ASX ERTH. This is the BetaShares Climate Change Innovation ETF. Now this ETF is a bit different in a sense that it holds a portfolio of 100 global companies that get at least 50% of their revenue from products and services that help address the issue of climate change. So these companies not only focus on clean and renewable energy, but also other areas like green transport, waste management, energy efficiency, and so on. So the whole point of this ETF is to provide you guys exposure to companies that will benefit greatly in the future as the world moves towards a much more sustainable model. So some key facts for this ETF: the management fees are 0.65%, which again is pretty costly. The distribution frequency is semi-annually. And having a look at the portfolio holdings, you guys can see some of the names of these companies which you might not know about, but it's important to note that these companies are well positioned to take advantage of this mega trend that's going to keep on continuing. But then again, you guys can still see some familiar names like DocuSign, Tesla, and Neo, and so on. Now digging a bit deeper into this ETF's holdings, and this is where it might start to make a bit of sense, because as you guys can see, each company is carefully chosen for its category, as all these companies are constantly innovating. So as you guys can see, for the category of renewable energy, you've got Vestas Wind Systems and a few other companies, and they are specializing in wind turbines, solar, home clean energy, and storage. And then when it comes to green transport, you've got Tesla and a few other companies who are helping to innovate and constantly trying to change to take advantage of the future. And then you've got Beyond Meat as well in sustainable products. So you can see that these companies are quite different to other sustainable ETFs, so it might be worth having a look at. Now, having a look at the sector allocation, we can see that the biggest category is building products at 15%, Then you have 13% in automobile manufacturers, so you can see that it's quite different to other ETFs. And the country allocation again leans towards the US, but then you also have China and a lot of other European countries as well. Now, having a look at the returns for this ETF, it is around 0.67% per annum. Now, this isn't really too useful because this ETF literally got listed like 2 months ago, so it's not going to be too accurate. But if you believe in the companies and you want to take advantage of this climate change revolution, it might be worth having a look at. Now, the last and final ETF on this list is ASX DZZF. This is a BetaShares Ethical Diversified High Growth ETF. Now, in a nutshell, this is a high growth ETF which invests 90% in high growth assets and 10% in defensive assets like fixed income products like bonds, for example. Now, this ETF is quite unique in a sense that it invests in 3 other BetaShares ETFs and it allocates them as we mentioned before. So if you guys have heard about Vanguard's VDHG ETF, this is kind of like VDHG but a BetaShares version, and it's a more ethical version of VDHG. And that's just a very simplistic way to put it. Now, at the start of the video, we discussed 2 ETFs which were Ethy and Fair, and based on this pie chart, we can see that right now 54% is allocated towards Ethy and 36% is allocated towards Fair, and the rest is in GBND, which is a fixed income ethical ETF. So basically guys, if you want to get exposure to ethical companies that are international and based in Australia and get a bit of exposure to the defensive side of things as well, just by buying this one ETF, you'll get exposure to all of that. So essentially, instead of buying those 3 ETFs individually, you can just make this one purchase and you can get an overall picture, but that's up to you. Now, just keep in mind that this ETF is quite volatile because it invests in 90% growth assets, so it's meant for long-term holds only. Some key facts for this ETF, and we can see that the management fee is 0.39% and it pays a dividend frequency which is quarterly, which is good, which means that you'll get a dividend 4 times a year. Now, the asset allocation once again leans towards technology at 25%, healthcare and financials, which is pretty similar to the other ones that we had a look at. And the country allocation, we can see that a lot of it is based in Australia because of the large percentage allocation to the Fair ETF that we had a look at, which is of course the Australian ethical ETF. So guys, these were the top 5 ethical ETFs for you to have a look at. But once again, I do have some bonus ETFs for you guys as well to have a look at. So let's get into it. So the first bonus ETF that we had is ASX VETH. This is a Vanguard ethically conscious Australian shares ETF, and this is very similar to ASX Fair that we just discussed in this video, and they have a super low management fee of 0.16%, once again in true Vanguard fashion. And the second ETF is ASX GRNV, and this is by Van Eck, and this ETF gives you exposure to sustainable companies on the ASX, and they have 86 holdings. And again, this is pretty similar to ASX Fair and VETH. And the last and final bonus ETF that we have on this list is ASX ESGI. This is again by Van Eck, and this ETF invests in sustainable companies that are international, excluding Australia. Now, a fun fact about these Van Eck ETFs specifically, you can buy these ETFs completely free of cost, meaning that you won't pay any brokerage if you use a new CHESS-sponsored broker called Perla. As long as you buy this ETF and you hold it for a year, you won't have to pay any brokerage fees. And if you sign up with Perla and use my invite code, which is just my name, FYZEE, Fyzee, you will also get a free investment credit as well, which means that you can do one trade completely brokerage free as well. Now guys, if you want to know more about Van Eck ETFs, this video compares the top 5 Van Eck ETFs for you to have a look at, and this video is about the top 5 Vanguard ETFs, and this is about the top 5 BetaShares ETFs. So go check it out. And guys, thanks for watching. Please like and subscribe, and I'll see you in the next one. Bye now. Specifically, these Van Eck ETFs is